What is ROI, or return on investment, for an investment center? Or how do you use ROI to check an investor center's performance? Well, to start with, an investment center is really a subcomponent of an organization, a responsibility center, if you will, but the responsibility that it has is to make money from investment. So you are taking money or resources of the company in the form generally of money, allocating that towards a project, and the project should have a positive return. And so you use return on investment to measure that. Because if the overall objective is profit and efficient use of assets, ROI tends to be the best indicator of performance of the investment center. Other responsibility centers might have other purposes or tasks in the organization, whether their task is primarily spending money or bringing in revenue. In a scenario where bringing in revenue is the more important thing, again, ROI may not be the most important aspect because you may have a huge investment of assets to bring in that money, where some of those assets are also used in other things. So once again, that wouldn't be the best metric for performance. Or another responsibility center that seeks to reduce costs. Again, how much money you bring in would not be a good return. So anyway, for the investment center, ROI is it. Now, there are two primary methods of calculating ROI. The first, the simplest if you have these numbers before you, are operating income, okay, the money brought in from operations, divided by the total value of assets you allocated towards the project. You allocate $100, you bring in 120, the return on investment is 1.2 minus the one you put in, so that's 20%, right? So that's your ROI. Another way of calculating, however, is by multiplying your profit margin, right? Whatever you bring in above your costs, times your asset turnover. That will also give you ROI. So what are the elements of that? Profit margin is your operating income divided by your operating sales, okay? Now, what that tells you is the percentage of sales dollars, right, ending up as profits, okay? That's why they call it the profit margin, right? So anyway, you take your profit margin and you multiply it by asset turnover, which asset turnover is simply your sales divided by your sales of assets divided by your total assets, right? How fast you're turning those over. You get a metric there. So generally, that's going to be the component that tells you how efficiently you use your assets to generate sales or sales revenue. So with that said, if you can multiply the profit margin by the asset turnover, once again, that's another metric for getting return on investment that can be used in the profit center as a metric of performance.